In today's episode, we'll break down two important stories. First, we'll talk about how Suzlon survived by selling to itself, and then we'll talk about the cost of defending the rupee. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara. Today is Tuesday, 2nd June. Coming to the first story. So in March 2014, Suzlon Energy sold one of its businesses for rupees 2,000 crore, about 26 times what the business was worth on its own accounts. It would have been a remarkable sale, but for the fact that the buyer wasn't some outside investor. It was a subsidiary it had set up itself. In a year when its group was bleeding money, the company booked a profit of nearly rupees 1,923 crore. And in an order dated 29th May 2026, SEBI looked at that sale and a handful of similar deals, calling them what they were, a way for a company on the edge of collapse to look healthier than it actually was. You probably know Suzlon as one of the Indian market's great turnaround stories, a wind energy company that fell to a penny stock before clawing its way to becoming a near 80,000 crore rupee giant. This is the story of how it bought the time to do just that. Now, to understand why it would bother dressing its books, you need to understand how close Suzlon came to going under. So Suzlon was founded in 1995 by Tulsi Tanti, a textile businessman who got into wind energy to solve his own factory's power problems. From there, it spent the 2000s becoming one of the world's largest wind turbine makers. And it did this the risky way, borrowing heavily to buy companies abroad, including a German turbine maker called Zenvion. Then the 2008 financial crisis hit. The company's overseas markets froze, orders dried up, nobody wanted turbines when the world was melting down. Only their debt didn't go anywhere. By the early 2010s, Suzlon owed banks well over rupees 13,000 crore. Things were desperate. And so in 2013, its lenders stepped in with what's called corporate debt restructuring, or CDR. They effectively gave it more time and gentler terms rather than force it into bankruptcy. And in March 2013, a consortium of 19 banks led by State Bank of India restructured roughly rupees 9,500 crore of Suzlon's debt. But that rescue came with conditions. Suzlon had to sell assets, raise fresh money, and crucially, keep its balance sheet from looking too broken. Their net worth, or the amount of money they would have been left with if they sold everything and paid off all their debts, could not drop below zero. If that happened, the conditions of the restructuring would be breached and the arrangement would come crashing down. This has become an existential matter for Suzlon, and no matter how the broader business fared, it needed its accounts to look good and for its net worth to stay positive. And so in 2014, Suzlon sold its operations and maintenance arm, which is the unit that services wind turbines after they're installed. The business was worth about Rs 77 crore on Suzlon's own books. But then Suzlon sold it in one lump to Suzlon Global Services, a wholly owned subsidiary for Rs 2,000 crore. Somehow, in shifting the company from one arm to another, it had recorded a profit of Rs 1,923 crore. There was no way Suzlon Global Services could actually pay any of that. It was barely more than a name on a piece of paper, and its assets at the time amounted to just Rs 4 lakh. Over the next many years, it would somehow manage to push Rs 700 crore into Suzlon's bank accounts. Now that still left Rs 1,300 crore in unpaid dues. And so the company constructed a ruse, effectively making it seem like the money had all been paid. Over the period of a few days in March 2017, Suzlon and its subsidiary moved money back and forth between their accounts, and the same funds would go out and then come straight back again and again. Each loop would be recorded as a payment. So imagine I give you a 100 rupee note and then ask you to return it immediately over and over again. Each time you give me the note, I write down paid 100 rupees before sliding it right back. If we do this long enough, on paper, I can make you pay me any amount of money, whether or not I'm any richer by the end. That's what Suzlon did. Of course, this didn't increase Suzlon's bank balance, but that was never the point. The point was to get rid of an awkward line in their accounts, and for all those years, according to Suzlon's books, its subsidiary owed it Rs 1,300 crore. This circular exercise let Suzlon erase that line. Now, on paper, the old sale was closed. Suzlon just happened to give it another rupees 1,300 crore in routine loans that year and bought convertible bonds from it. So bygones were now bygones. Suzlon had successfully booked a rupees 1,923 crore paper profit, and new loans were something to be dealt with later. So why go through all this trouble? This was to keep their net worth from hitting zero. The very next year, Suzlon recorded a loss of rupees 6,000 crore in assets it had finally admitted were impaired. Had it not inflated its net worth just in time, that impairment would have pushed its net worth below zero. Then the conditions of its debt restructuring would have been breached, all its loans would instantly come due, and everything would fall apart. Now, it would be one thing if Suzlon did this once. But to SEBI, the larger problem was that this quickly became a pattern. In 2015-16, for instance, it sold its shares in Suzlon Global Services, the buyer in its last deal, to yet another subsidiary, Suzlon Structures. This brought in an extra paper profit of about rupees 830 crore. And then it got even more creative. So the company had a Dutch subsidiary, for instance, that was in need of a loan. To guarantee that loan, Suzlon asked the State Bank of India to issue a rupees 4,050 crore letter of credit. If there were ever a default, the lenders would go to SBI for money, who would in turn recover it from Suzlon. And in 2016-17, Suzlon showed this in its books honestly as a contingent liability, which is money it may have to cough up in case things went wrong. But then it slowly began to disappear from its books. The next year, it became an insurance contract instead and was quietly dropped from its contingent liabilities. But the bill would come due in October 2019 when the subsidiary would default on the loan. And the same sort of thing would happen again and again. For instance, the value of one of their subsidiaries, SE Forge, kept fluctuating in its books. One year, it wrote down its investment in it, essentially declaring it worthless. The very next year, while scrambling to raise money, it declared that the business had recovered and added the value back again. Later on, it wrote the investment down yet again. Now, Suzlon had given loans to SE Forge as well, but with some accounting alchemy, those loans would turn into investments. Or take Suzlon Gujarat Wind Park. Suzlon claimed to invest rupees 1,200 crore of fresh capital in the company, but all that money circled right back. Meanwhile, just 10 days later, that 1,200 crore rupee investment was sold to another subsidiary for rupees 192 crore. As these allegations piled up, Suzlon tried taking cover under technicalities. So in each case, they had appointed reputable valuers and had the deals approved by their board and by shareholders. Everything was disclosed to stock exchanges, independent auditors had given their seal of approval, everything thoroughly stamped and signed. SEBI, however, brushed that aside. If you were trying to dress up your books, it didn't matter if you followed all the procedures carefully. It didn't matter if the company eventually emerged as a profit-making entity and no investor was harmed. You can't mislead people with your accounts no matter how impressive your paperwork is. Now, Suzlon almost got away with all of this scot-free. Now, SEBI had looked at this matter before. In 2019, it began an investigation, asked for a forensic audit, and asked Suzlon's executives for an explanation. But last year, SEBI's adjudicating officer cleared all of them. They found no violation and no penalty. The matter seemed dead. But it wasn't. So SEBI has the power, although used rarely, to reopen and revise its own officers' decisions if it finds them wrong and damaging to the market. The clean sheet didn't make sense. SEBI took it down and looked at the matter more strictly. Now that said, for all that drama, the final bill is small. So SEBI fined the 5 parties a total of about rupees 28.95 crore. There's no market ban and no demand to redo the old accounts. So Suzlon is now a company worth close to rupees 80,000 crore, earning over rupees 2,000 crore a year. And the fine to them is a rounding error. That's probably why the stock barely budged when the order came out. So for less than rupees 30 crore, which is a pittance, Suzlon managed to keep itself alive for long enough to crawl out of destitution and survive until the renewables industry finally took off. In 2022 and 2023, it raised actual equity of rupees 1,200 crore through rights issue, where shareholders put in real cash. And it used that money to clear its debt for good. Finally, the company genuinely had a positive net worth. In 2020, when the company was gasping for air, the stock was worth just rupees 1.58. Any investor that bought in then multiplied their money many times over as the stock reached high 50s. Regardless, the company will appeal SEBI's order to the Securities Appellate Tribunal. That should be the next chapter in a fascinating saga. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That's exactly what we do in Points and Figures, a weekly newsletter we send out every Tuesday. Link is in the description. Coming to the second story. On May 26, the Reserve Bank of India conducted a $5 billion USD INR buy-sell swap auction with a 3-year tenor. 254 bids came in from banks, totaling $9.8 billion, nearly twice the amount on offer. The RBI accepted 141 of those bids at a weighted average premium of Rs 9.2 per dollar. Now, if you understood none of those words, don't worry. We also struggled a little when we started looking into the swap. So in simple terms, what it means is that the RBI wants to sell rupees and buy dollars from Indian banks and do the reverse transaction 3 years later at an agreed upon rate. So if the banks sell $1 to the RBI for the current exchange rate, say rupees 95, they'll buy back the same dollar amount at a premium of rupees 9.2 over the current exchange rate. That premium is the price banks were willing to pay the RBI to borrow rupees for 3 years using their dollars as collateral. And given that it was nearly doubly oversubscribed, clearly the banks wanted rupees a lot more than dollars. But why would the RBI conduct such an operation? How does it affect the various objectives that the RBI sets for itself in a given time span? It's because much of this swap has something to do with the RBI's defense of the rupee since 2024. So let's zoom out a little bit. As we covered before, since 2024, well before the Strait of Hormuz crisis, India's rupee has been under pressure due to a worsening import bill, plus the persistent selling of Indian equities by foreign investors. And repeated tariff announcements from the US didn't help. And then a historic oil shock has only accelerated the decline. So the RBI defends the rupee by selling dollar reserves for rupees. In FY26 alone, RBI net sold a record $53.13 billion in the spot market. But every dollar it sells sucks rupees out of the banking system. Defending the rupee, in other words, comes at a cost. And that cost is a domestic liquidity crunch. So the swap auction is how the RBI tries to fix that crunch. But understanding why it needs to fix it and why the fix might be creating its own problems requires understanding what the RBI is actually juggling. So the RBI at any given time has many different objectives to reach. But the achievement of one of them usually pulls back the other. The central bank then manages multiple jobs that often pull in divergent directions. For instance, on one hand, the RBI is the custodian of the rupee. It manages the exchange rate and protects the rupee from sharp appreciations or depreciations against the dollar, the global reserve currency. On the other hand, it also manages rupee liquidity, making sure that the domestic banks have enough rupees to lend and create credit. Now, the problem here is that the main tool for the first job often creates a setback in the second. So here's what happens. When the RBI sells dollars to prop up the rupee, it receives rupees in return, and those rupees exit the banking system. So if the RBI is selling billions of dollars every week, the cumulative drain is enormous. Banks find themselves short of rupees and interbanking lending rates spike. So the RBI usually tries to keep the call rate, the rate at which banks lend to each other for very short time periods, close to the policy corridor surrounding the repo rate, which is usually 25 basis points above or below the repo rate. Currently, that band is 5 to 5.5%, and the call rate had spiked to 6.9% towards the end of March 2026, reflecting a deep liquidity crunch. So the RBI needs a way to put the rupees back in, but it also needs to keep defending the rupee, and it needs to do both without looking like it's running out of ammunition. That's where reserves come in. India holds roughly $690 billion in foreign exchange reserves, among the largest stockpiles in the world. In theory, the RBI can sell dollars when the rupee is weak and buy them back when it's strong. But here's the catch. Our dollar reserves have become what Indian economist Rajeshwari Sen Gupta calls a barometer of macroeconomic health. When the headline number falls too fast, markets get more concerned. Foreign investors may also read it as yet another distress signal and pull money out faster, which weakens the rupee further. In a weird doom loop, the intervention creates the very conditions that undo itself. Now, instead of selling dollars today and watching the reserves fall, the RBI can promise to deliver dollars sometime in the future, say 6 months from now. This is a forward sale. No reserves leave the vault today, and the headline reserves number stays intact for now. But a forward sale only defers the need to deplete reserves. It doesn't make the problem disappear completely. When the contract matures 6 months later, the RBI has three choices. One, it can deliver the dollars, which means reserves finally fall. Two, it can buy dollars in the spot market to fund the delivery, but that means buying dollars, which pushes the rupee down, the opposite of what it wants. Or lastly, it can roll the same contract into a new forward, only kicking the obligation further into the future. Now, over the past 2 years, the RBI has leaned heavily on the third option. Its net short forward position, which is the total value of dollars it is committed to deliver in the future, has swelled from roughly $10 billion in early 2024 to an estimated $103 billion by end March 2026. That's $103 billion worth of dollars the RBI has promised to deliver but hasn't yet. This is the hidden cost of defending the rupee. The headline reserve says $690 billion, but $103 billion of that is already spoken for, and another $115 billion is in gold, which is valuable on paper but isn't liquid enough to be sold quickly. So how does the RBI swap auction come in here? So here's what actually happened on May 26th. Banks sold $5 billion of their dollar holdings to the RBI at the prevailing spot rate, which was approximately rupees 95.44 per dollar. The RBI then credited around rupees 47,700 crore to their accounts. The banks agreed to buy those dollars back 3 years later at the spot rate, plus a premium of rupees 9.2 per dollar. Now, for the RBI, this accomplishes several things at once. It puts a huge amount of rupees back into the banking system, addressing the liquidity hole that its forex intervention created. And now that the RBI has bought dollars, it also temporarily adds $5 billion to the headline reserves. Such a move might also let the RBI manage its forward book by converting shorter dated bilateral forward obligations into a clean 3-year commitment. Now, there's usually another secondary but important reason as to why RBI may conduct a swap. This is to help temper future expectations about the availability of the dollar. For instance, with the Strait of Hormuz crisis, naturally everyone's worried about the future. It could be a prolonged crisis, it could be a war, who knows? Those worries manifest themselves in the forward exchange rate. In fact, the 1-year forward USD INR rate briefly touched rupees 100 per dollar just last week. So to help bring down the forward rate, the RBI might conduct a swap. In fact, even after this auction, the 3-year forward premium fell from rupees 9.25 to rupees 9. So what's the bank's end in this trade? They may have dollar deposits and export receivables that they don't need immediately compared to rupees. But more importantly, the counterparty in this swap isn't just another bank. It's India's central bank, and that makes the credit risk essentially zero. Usually, such a swap can take place without an auction. Bilateral swaps still happen a lot more often than swap auctions. They are business as usual liquidity options for the RBI. But an auction is usually done when the scale of the swap is huge and when the RBI wants to know a market clearing price. See, this auction had a cutoff of rupees 9.1, meaning every bid below that was rejected. 113 banks didn't get in. The fact that the weighted average premium of rupees 9.2 was higher than the cutoff tells you most successful bidders were willing to pay even more. This is a market showing its hand. Now, the buy-sell swap auction is not a very new instrument, but its current frequency is unprecedented. So the RBI started the format in March 2019 under then-Governor Shaktikanta Das, and the context was a routine liquidity deficit. Banks needed rupees, and the RBI had exhausted its bond buying capacity. The first $5 billion auction was oversubscribed 3.3 times. A second followed in April 2019. Then the RBI used it again in March 2020, just as COVID began, but in the opposite direction. In this case, the RBI actually sold dollars to banks during the pandemic when the global market was desperately short of dollar funding. The current cycle is different in both scale and urgency. Since January 2025, the RBI has conducted 7 buy-sell swap auctions, totaling at least $55 billion. The January 2025 auction alone was oversubscribed fivefold with $25.6 billion in bids against $5 billion on offer. Interestingly, over time, the premium bid by banks has risen. The weighted average premium banks paid has climbed steadily across these auctions, rupees 6.73 in February 2025 to rupees 7.51 in February 2026 to rupees 9.2 now. Each auction is more expensive than the last. This escalation tells you something about the scale of the problem. The RBI keeps needing to come back to the auction window because the underlying cycle hasn't broken. It sells dollars to defend the rupee, which drains rupee liquidity, which forces it to inject liquidity via swaps. But that in turn builds up its forward book, which erodes future reserves. Each round trip leaves the balance sheet a little more encumbered than the last. Now, the swap auction is sophisticated plumbing. It puts rupees where they're needed, it avoids the visible stigma of reserve depletion, and it buys the RBI time until the external pressure on the rupee reduces. But it doesn't fix the underlying problem. The rupee's weakness reflects both structural and cyclical pressures. India's dependence on imported energy is one such structural vulnerability, while recent foreign portfolio outflows have added to the pressure. No amount of swap auctions changes that equation. Now, the RBI can keep doing this for a long enough while. It has the reserves to withstand that kind of pressure. But what complicates the equation is the market's expectations of where those reserves should be. The cost of that then becomes deferred to a bill that only comes in the future. The question that remains is how large that bill might get before the market starts paying more attention to it than to the headline reserves number. Now coming to the tidbits. Myanmar's President Min Aung Hlaing is visiting New Delhi, and the government is looking at this as a significant opportunity for India as we aim to secure rare earth minerals from the neighboring country, a resource currently dominated by China. Coming to the next tidbit. Factory output grew at 4.9% in April as against 5.7% during the corresponding month of last fiscal, the Statistics Ministry reported on Monday. This is the first print under the new base year of 2022-23. Coming to the final tidbit. The Russian government has imposed a ban on aviation fuel exports until November 30th, 2026. The decision has been taken to ensure stability in the domestic fuel market, the government said. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.